Welcome to the deep dive. We're here for those of you who really want to cut through the noise and get truly well informed quickly. Today, we're tackling something that often feels, well, pretty complex, but it's absolutely vital if you want to understand finance: analyzing companies for smart investment decisions. We've used your sources a great mix of financial data and expert views, and our goal here is to pull out the key insights. We want to empower you with a real understanding of company performance and value without you getting totally buried in numbers.
Exactly. Think of this as your shortcut to figuring out what really matters when you look at financial statements.
Yeah.
We'll start with the basics, how you actually invest in shares. Then we'll quickly cover the two main ways to analyze them: technical and fundamental. After that, we'll really zoom in on some key financial ratios, the ones that tell you about a company's health. And finally, we'll talk about the good and the limitations of using this data. You should leave with a much clearer way to approach analyzing companies.
Okay, sounds good. So let's unpack that first bit. Investing in shares or equities. For a lot of people, that's the starting point. How do you actually go about buying shares?
Well, there are a few main ways. First, you might buy them when they're first offered to the public. That's called the primary market. Usually happens through an IPO, an initial public offering.
Right, when the company first sells shares.
Exactly. Then there's the secondary market. That's probably what most people think of buying and selling shares that are already out there, owned by other investors. Think of stock exchanges like the JSE example in the sources. That's the secondary market.
Okay.
But there can be a practical hurdle, especially for smaller investors. Often, shares trade in minimal amounts, like lots of 100. So using that example of a shares are 200, buying just one lot costs are 20,000 plus commission. Buying just one or two shares directly can be tricky or impossible sometimes.
That's a significant amount.
It is. And that's where things like unit trusts come in. They're really useful, especially for smaller investors or anyone wanting diversification. Basically, unit trusts pool money from lots of people. Fund managers take that pool and buy a whole range of different shares, spreading the risk.
Ah, so you don't have to buy those big lots yourself.
Precisely. It lets you invest smaller amounts, maybe monthly, and get exposure to many companies. Like that analogy in the sources investing R500 a month, effectively putting R15 into 10 different companies without needing to buy 100 shares of any single one. It's a way to get started and manage risk without needing huge capital.
That clears up the how nicely. But then comes the big question. What should you invest in? How do you figure out what a company's shares are actually worth? This seems to lead us to technical versus fundamental analysis.
Right. Two very different schools of thought here. Let's start with technical analysis. Technical analysts work on the idea that market prices move in patterns and trends, and these patterns aren't random. They believe you can spot them and use them. Their main tools are charts, looking at price movements and how many shares are traded over time using various stats and indicators.
So they're looking purely at market activity.
Pretty much. The core belief is that all the important information about a company is already baked into the share price. So from their view, spending time on financial statements is, well, they might say a waste of time. They often say, trends are your friend.
Interesting. What's the thinking behind that?
The assumptions are basically supply and demand set the value. Lots of factors influence supply and demand: moods, guesses, opinions, you name it. Prices tend to move in trends that persist, and you can spot changes in those trends by watching the market action itself.
Okay, so that's technical. What about the other side, fundamental analysis?
Fundamental analysis is quite different. It's about looking at the business itself. You analyze its financial statements, its overall health, the quality of its managers, its competitive edge, who its rivals are, the markets it operates in. The whole 9 yards.
So much more focused on the company's intrinsic qualities.
Exactly. You use past and present data, but the main goal is to project the company's future financial performance. People use it for lots of things: figuring out credit risk, predicting business results, checking out the management, making internal decisions, and crucially for investors, valuing the stock and trying to predict where the price might go. The core idea: you invest based on the gap between what you calculate the company's fundamental value to be and its current share price. The bet is that the market will eventually recognize that true value.
So one looks at charts and market mood, the other looks at the business's books and prospects. It feels like they could give you very different signals sometimes. How do you reconcile that?
That's a great point. They definitely can give different signals in the short term. But, many experienced investors find value in using both. They're not really mutually exclusive. They could be complementary.
So
Well, a common way to think about it is this. Fundamental analysis helps you decide what to buy or sell, which companies are fundamentally strong or weak. Then, technical analysis can help you decide when to actually make the trade, timing your entry or exit based on market trends. Using both can give you a more rounded view.
Okay, that combination makes sense. Finding a good company and a good time to invest. And speaking of finding good companies, that brings us right to financial ratios. If you're aiming for sound, long-term decisions, you absolutely need to get past just the share price or one good earnings report. Ratios seem like the way to do that. They simplify those dense financial statements, right? They help you spot trends and check the company's health without drowning in data. Our sources group them into four main types: profitability, liquidity, gearing, and investment ratios. Let's dive into gearing ratios first. What do they tell us?
Gearing ratios are all about how the company finances itself, specifically the balance between debt and equity, meaning money borrowed versus money invested by owners or shareholders. It's fundamentally about risk and potential return. More debt generally means more risk, but also the potential for higher returns if things go well.
And equity.
Equity financing using shareholders' money is usually seen as less risky, but potentially more expensive in terms of the return shareholders expect. So a company with high gearing, meaning lots of debt compared to equity, well, it can deliver great returns in good economic times. But if things turn sour, like in a recession,
They're more vulnerable.
much more, because they have to make those fixed interest payments on their debt. Companies with less debt have more flexibility. They could, for instance, cut dividend payments to shareholders if needed. A highly geared company doesn't have that same wiggle room with its debt payments. The sources mention that a gearing ratio above 100% usually means it's highly geared, more long-term debt than equity.
Got it. Are there specific ratios we should look at?
Yes. Two key ones mentioned are the debt-to-equity ratio and the total gearing ratio. The debt-to-equity is straightforward. You divide the company's non-current liabilities, essentially its long-term debt, by its total equity. A lower ratio suggests the company is better positioned to handle its interest payments, even if business slows down a bit. A higher ratio, conversely, can lead to bigger returns for shareholders, but it definitely comes with more risk.
And the total gearing ratio.
Similar idea, just calculated slightly differently. It's long-term liabilities divided by capital employed. And capital employed is just the total equity plus the long-term liabilities. Both ratios essentially measure the same thing: the company's financial leverage and its associated risk level.
Okay, so gearing gives us a handle on the company's debt situation and risk profile. Let's shift gears now to market value ratios. These seem focused more directly on the shareholder's perspective, the return they're getting, and how the market values their investment. The sources make a strong point that just looking at the share price alone is not very informative.
Absolutely right. The price itself doesn't tell you much without context. That's where these ratios come in. The first big one is earnings per share, or EPS. The calculation is earnings available to ordinary shareholders divided by the number of ordinary shares out there.
So how much profit belongs to each share?
Exactly. It measures the profit earned per share. Generally, a higher EPS is better. It suggests the company is profitable and potentially has money to pay dividends, though, importantly, not all profit is paid out. There's that example. ABC Limited makes R4 million for shareholders, and there are 10 million shares. Simple division. R4 million divided by 10 million shares gives you an EPS of R0.40 for that quarter. It's a key measure of profitability per share.
You also mentioned basic versus diluted EPS.
Right. Basic EPS is just based on the current number of shares. A diluted EPS considers other things that could become shares in the future, like stock options or convertible bonds. It shows what EPS would be if all those potential shares were issued. It's usually seen as a more conservative and perhaps more accurate measure, often the one-sided.
Okay, so EPS tells us the earnings per slice of the pie. What's next?
Well, knowing the earnings is one thing. Knowing how the market values those earnings is another. That brings us to the price-earnings ratio, or PE ratio, probably one of the most famous ratios. The formula is simply the current market price per share divided by the earnings per share we just talked about.
And what does that tell us?
It essentially reflects investor confidence. It shows how much investors are currently willing to pay for every 1 rand or dollar or whatever currency of the company's earnings. Generally, a lower PE is often seen as better, suggesting the stock might be cheaper relative to its earnings.
And a high PE.
A high PE could mean the stock is expensive, or it could mean investors rate it very highly and expect strong future earnings growth. So you can't just look at the number in isolation. Context is key. That crucial example comparing Company A and Company B really drives this home. Remember how the source emphasized that share price alone is almost meaningless for comparison?
Right, like the Shabin shoe store scenario, comparing it to a giant based on price wouldn't work.
Exactly. So company A has a R50 share price, company B's R40. Company A looks more expensive, right?
On the surface, yes.
Both earn R50 million. Company A has only 10 million shares, giving it an EPS of R5.00 and a PE of 10, R50 price, R5 EPS. Company B has 30 million shares, so its EPS is only R1.67 and its PE is 24, R40 price, R1.67 EPS.
Ah, so even though company A's share price is higher, its PE ratio is much lower.
Precisely. It means you're paying less for each rand of earnings with Company A. Assuming everything else is equal, Company A looks like the better value, despite the higher sticker price per share.
That's a really important illustration. So how do you know if a PE is high or low?
You compare it. Compared to the company's own historical PE ratios to its direct competitors, to the industry average, or to the overall market average, that gives you context to judge if it seems undervalued or overvalued. But again, like the source says, it's by no means a perfect gauge, just one piece of the puzzle.
Okay, PE links price to earnings. What about direct returns to shareholders, like dividends?
Good point. That's where dividend yield comes in. Calculation. Take the annual dividend paid per share, divide it by the current share price, and multiply by 100 to get a percentage. So if a share costs R100 and pays out R5 twice a year, that's R10 total, the dividend yield is 10%, R10, R100, 100. It's the cash return you expect as a shareholder from dividends alone.
And shareholders like high yields, presumably?
Generally, yes, but with a caveat. Shareholders look for total return that's dividend yield plus capital growth, share price going up. A very high dividend yield might actually be a warning sign. It could mean the company is paying out a huge chunk of its profits and maybe not reinvesting enough for future growth. Or it could mean the market thinks the dividend is unsustainable and the share price has fallen, pushing the yield up. So, context again.
Understood. High yield isn't automatically good. What other dividend ratio is important?
The dividend payout ratio. This one compares the dividend per share directly to the earnings per share. Formula. Dividend per share divided by earnings per share. It tells you what proportion of the company's profit is being paid out as dividends versus what's being kept or retained for reinvestment and future growth.
So if the payout ratio is 40%,
It means 40% of earnings are paid out to shareholders, and the company retains the other 60%. This ratio can also send signals. For instance, if profits dip slightly, but the company maintains the dividend, keeping the payout ratio steady or even increasing it, it can signal confidence to shareholders about the future. A consistently high ratio might suggest profits are stable enough to support future dividends.
okay. One more market value ratio mentioned was price to book value.
Yes, price to book value, or PB ratio. First, you need the book value per share. That's the company's net asset value, basically. Total assets minus total liabilities, which equals total equity divided by the number of shares. Think of it as the theoretical accounting value per share if the company were liquidated.
Okay, the accounting value.
Then, the PB ratio is simply the market price per share divided by that book value per share. It compares the market's valuation to the company's accounting value. If the book value is R10 and the market price is R15, the PB ratio is 1.5. This suggests investors believe the company is worth 50% more than its net assets are valued at on the books. It often reflects things like growth potential, brand value, or other intangible assets not fully captured in the accounting book value.
Wow. Okay. We've gone through quite a few ratios there. Gearing, EPS, PE, dividend yield, payout, price to book. That's a powerful toolkit, but it does feel like you could get lost in the numbers. Let's step back. What are the overall pros and cons of relying on ratio analysis? It's not foolproof, is it?
No, definitely not foolproof. It's incredibly useful, but you need to be aware of the limitations. Let's start with the benefits. First, as you said, ratios make complex financial statements much easier to digest. They highlight key relationships and trends. Second, they're essential for comparison, comparing a company to its peers, its industry, or its own past performance. That's critical context. Third, they really do help in making more informed decisions, whether you're investing, lending money, or managing the company itself. They can also be used effectively in budgeting and planning.
And for managing risk.
Yes, absolutely. They help management spot potential financial issues early on and take corrective action. Proactive risk management.
Okay, those are solid benefits. What about the downsides, the limitations?
Well, a big one is that all the data comes from the past. Financial statements are historical records. They don't automatically predict the future. Inflation, market shifts, new projects, none of that is guaranteed to follow past patterns.
Right, looking backwards doesn't always tell you what's ahead.
Exactly. Another issue is accounting policies. Different companies might use different, perfectly legal accounting methods, or a company might change its methods over time. This can make comparing ratios between companies, or even for the same company across different years, less reliable. Apples and oranges sometimes.
Consistency is key for comparison.
It is. Also, think about large, diversified companies that operate in many different industries. Comparing their overall ratios to a single industry average can be misleading. Which industry do you choose?
Good point.
And then there's the potential for manipulation. Management might manage earnings or arrange transactions around year-end to make the ratios look better than they otherwise would. Window dressing, essentially.
So you need a critical eye.
Definitely. And finally, interpretation can be subjective. Is a 60-day average collection period for customer payments too long? Or is it perfectly fine, maybe even optimal, for that specific industry or business model? Different analysts might draw different conclusions from the same ratio.
That highlights the art part of analysis, not just the science.
Precisely. Ratios provide data, but judgment is still required. And, those examples in your sources, the Cyril Ltd financials and the Shabin Shoe Store scenario, they're perfect illustrations of how you actually apply these calculations and start interpreting them. Plus, resources like Reuters, as mentioned, provide these kinds of fundamental analysis reports all the time, showing how professionals put these tools to work.
This has been a fantastic deep dive. We've journeyed from the basics of buying shares through technical and fundamental approaches and really unpacked a whole suite of key financial ratios. You started out wanting to get quickly informed, and hopefully you now feel equipped to look beyond just a share price and start assessing a company's actual financial health and value.
Absolutely. The key takeaway is that using a combination of these methods and ratios gives you a much richer understanding than relying on any single number. But always remember, these ratios are tools for analysis and interpretation, not crystal balls. Understanding their limits is just as important as knowing how to calculate them. They raise questions, guide your thinking, but don't give automatic answers.
Well said. So, knowing that ratios are powerful lenses but have their blind spots, here's something to think about. What's one area of a company, beyond just the numbers we've discussed, that you're now most curious to dig into to really understand its true value? Keep exploring, keep asking questions, and keep looking for the story behind those figures.